Hello. In this presentation, I'm going to take you through an introduction to working capital. The management and financing of working capital are the subject of separate presentations. Specifically, this presentation will cover what is working capital, what are the objectives when managing working capital, how do we measure it, and why is it important? Let's look at each of these in turn. What is working capital? Working capital, or net current assets, is represented by current assets minus current liabilities. In their simplest form, current assets will include the inventory that is sold, the receivables due from customers in respect of sales made on credit, and cash. Current liabilities will include payables owed to suppliers in respect of purchases made on credit. Collectively, it reflects the short-term investment that companies make in their day-to-day operating infrastructure. It has been described as the lifeblood of an organisation. In other words, businesses cannot survive without it, and whilst its significance will vary from one type of entity to another, most, if not all, organisations will require some level of investment in this area. Objectives of working capital. There are two objectives: one, profitability, and two, liquidity. Profitability can be improved if a company appears attractive to its current and potential customers. A customer who likes a company will buy more and, conceivably, be prepared to pay more for what they do buy. A company can appear attractive by offering generous credit terms or by holding lots of inventory. High inventory levels suggest that a business can offer a wide choice and or fast delivery. Liquidity refers to the amount of cash and cash equivalents that a company can rely on when meeting financial obligations, i.e. paying the bills. Unfortunately, these two objectives conflict. For example, to promote profitability, a company may use all of its cash resources to acquire inventory. However, having done so, they then have no way of settling debts. Accordingly, working capital management is concerned with finding the right balance, i.e., investing enough to attract customers whilst at the same time maintaining sufficient liquid resources. The compromise required can be depicted by the cash operating cycle, and this aspect will be discussed in more detail in a separate presentation. How do we measure it? The simplest measure of working capital is the current ratio, calculated as current assets divided by current liabilities. For example, a company with current assets of £200 and current liabilities of £100 has a current ratio of 200 divided by 100. This indicates that they can meet their short-term liabilities twice over. But let's look at this relationship in a little more detail. Assume that a company has current assets of £500, comprised of cash of £50, receivables of £100, and inventory of £350. It also has current liabilities, represented by payables, of £250. As above, the current ratio is 2 500 divided by 250. However, let's consider the practicalities of the situation. Imagine that all of the suppliers to whom we owe money, £250 worth, turn up on our premises demanding payment. The only way to satisfy the immediate demand is to give them cash. However, we only have £50, which still leaves £200 worth of liability. Our next approach is to persuade the suppliers that we are owed money by our customers, and that as soon as we can recover that, we will settle with them. This should buy us some time. However, we are only owed £100, and even if we can collect all of it, we will still owe a further £100 to our suppliers. The only resource now left is inventory. However, can we turn inventory into cash quickly enough to keep our suppliers happy? The only true answer to this last question is it depends. It depends on what the inventory is and the line of business you are in. If you are a supermarket and inventory is loaves of bread, they were baked this morning and are cash in the till by lunchtime. If, however, you are a construction company and inventory is bags of cement, this will take much longer to turn into cash. Notwithstanding this debate, it may be more appropriate to exclude inventory from the current ratio. So current assets minus inventory divided by current liabilities. This more prudent view is called the quick ratio or asset test. There is no such thing as a single correct or optimal value for the current or quick ratios. However, we can get a feel for the appropriateness or otherwise of the ratios by comparing them to industry averages or similar companies in our industry. Why is it important? As described above, companies need to find an appropriate balance between the conflicting objectives of profitability and liquidity. Failure to get this balance right can have damaging and potentially catastrophic consequences. An organisation that invests too much in working capital is sometimes referred to as overcapitalised. Conversely, a company that does not invest enough, with insufficient long-term finance to support it, is said to be over-trading. Thank you. Hello. In this presentation, I am going to take you through the working capital cycle, also known as the cash operating cycle or cash conversion cycle. The working capital cycle refers to the period of time that a company is deprived of cash during a normal business operating cycle, and can be used to measure the level of money tied up and the associated cost to the company. This session provides further detail to that provided in the Introduction to Working Capital presentation, and it may be beneficial to watch that one first if you have not already done so. Specifically, this presentation will look at an explanation of the components of the cycle, negative working capital cycle, the importance of the cycle, how to measure the cycle, an interpretation of the cycle, and the sales to net working capital ratio. Let's look at each of these in turn. The components of the cycle. Imagine you are going to undertake a production process. Firstly, you will need some raw materials, and so will order some from your supplier. Upon receipt, these will be placed in the warehouse until you are ready to start producing and will show in the accounts within raw material inventory. When you're ready to start producing, the materials will physically be transferred from the warehouse to the factory and in bookkeeping terms will be moved from raw material inventory into work in progress or WIP. Other costs incurred, for example labour and overhead, sometimes referred to as conversion costs, will also be added into the WIP account. By the end of the process, the materials have been turned into products available for sale and are moved back into the warehouse or other appropriate area to await a customer. In the accounts, the relevant amount is now showing as finished goods inventory. At such time as the goods are sold, the value will be charged to profit or loss as cost of sales. However, assuming the sale is made on credit, no money is received from the customer at this stage. Instead, the amount owed to us by the customer is added to receivables. Effectively, the costs incurred are still shown within current assets, albeit now include a profit element, i.e. are based on sales value, and have been moved from inventory to receivables. Finally, the customer settles the debt, the amount is removed from receivables, and the company has received some cash. Whilst it will vary considerably from one industry to another, it is conceivable that many days will have passed between receiving the original raw materials and receiving the customer's settlement. The only offset to this is that assuming the company is itself creditworthy, it is likely to obtain the materials on credit, such that no cash will be paid out upon receipt. Rather, the amount owed to the supplier will sit in current liabilities as a trade payable for a period of time until the account has to be paid. Despite this, it is likely to be the case that for most businesses, cash for the raw materials will be paid out before cash relating to the eventual sale is received. It is this period between cash being paid out and received that is referred to as the working capital cycle. A negative working capital cycle. Notwithstanding the previous scenario, it is conceivable that an organisation could receive money from its customers before they are required to pay their suppliers. For example, a supermarket will hold items in inventory for a very short period, especially in the case of perishable food items. They will sell items for cash so that receivable levels are also short. Even where credit cards are used, the vendor will usually receive cash from such transactions within a few days. Finally, supermarkets have the power to negotiate extended credit terms with its suppliers, resulting in long periods of payables. This situation is sometimes referred to as a negative working capital cycle. The importance of the working capital cycle. In a previous presentation, an introduction to working capital, it was explained that profitability and liquidity were the objectives of working capital management. To date, this presentation has described that it is usual for a business to pay out to its suppliers prior to receiving in from its customers. The period between these 2 points is referred to as the working capital cycle and clearly puts pressure on the liquidity of the business as it is left with no cash with which to pay the bills. Additionally, There may also be an adverse impact on profit, as the company may need to borrow money to finance this period. The eventual cost of this borrowing will be influenced by both the amount of cash borrowed, i.e. tied up in working capital, and the length of time it is tied up for. Accordingly, it is important that both aspects can be estimated. Measuring the cycle. The amount of money tied up in the working capital cycle, and therefore the amount that is needed to be borrowed, is equal to the net current assets, i.e. current assets represented by inventory and receivables, minus current liabilities represented by payables. In order to establish the length of time money is tied up for, it is necessary to calculate the number of days for each element individually. Once these have been calculated, the working capital cycle can be calculated as receivable days plus inventory days minus payable days. Receivable days will equal trade receivables divided by credit sales multiplied by 365, the number of days in a year. Effectively, if receivables are £90 million and sales are £360 million, this suggests that a quarter of the year's sales are still outstanding, which equates to 3 months or approximately 91 days, a quarter of 365. On the same basis, payable days equals trade payables divided by credit purchases multiplied by 365. Raw material days equals raw material inventory divided by raw material usage multiplied by 365. WIP days equals WIP inventory divided by costs of production multiplied by 365, and finished goods days equals finished goods inventory divided by cost of sales multiplied by 365. Depending on the accounting information readily available, it may be easier and or necessary to combine the raw material, WIP and finished goods days into one inventory calculation expressed as inventory days will be inventory divided by cost of sales multiplied by 365. Interpreting the cycle. In arriving at the above days, a number of estimates and assumptions need to be made. For example, credit sales and purchases may not easily be separable from total sales and purchases, and so the days are often based on totals. Similarly, raw material purchases may be used as an approximation of raw material usage. Additionally, the year-end values may not be representative of normal operations. For example, inventory levels may be high in preparation for a new product launch or an upcoming sales campaign. For these and other reasons, the number of days calculated may not be completely accurate. Having said that, unless there is a dramatic change in the way the company operates, they are likely to be consistent from one year to the next. Accordingly, whilst the number may not be totally reliable, the trend should be, and so companies will often use the trend or movement in the days to assess the impact of control actions taken. There is no single correct answer as to what the various days should equate to. However, they are likely to be influenced by industry norms. Consequently, companies will often use industry averages or data from similar companies in the industry to gauge the appropriateness of the levels. More specifically, receivable and payable days ought to reflect the credit terms agreed with customers and suppliers respectively. Where this is not the case, tighter management controls may be required, and management of receivables and payables will be covered in more detail in a separate presentation. Sales to net working capital ratio. The sales to net working capital ratio shows the sales that can be generated from an investment in working capital of £1. For example, if a company has inventory of £100,000, receivables of £200,000 and payables of £120,000, this equates to net working capital of £180,000, 100 plus 200 minus 120. If sales are £1,260,000, this suggests that £1 of investment in working capital generates £7 of sales, 1260 divided by 180. The significance of this number is that it enables the company to estimate the additional investment that will be required as sales grow. For example, if sales are forecast to grow by £140,000 to £1.4 million, an additional investment of £20,000, 140,000 divided by 7, will be required, bringing the total investment to £200,000. A company that fails to plan for this requirement is effectively trading beyond its means or over-trading. Thank you. Hello. In this presentation, I'm going to look at the management of inventory. Inventory, or stock, refers to the raw materials input to a process, the finished goods that will be sold to customers, and work in progress whilst it is being transformed from one to the other. It is likely to be a significant value in both trading and manufacturing operations. Accordingly, it is important that inventory is managed carefully to ensure operational efficiency. Specifically, this presentation will cover the objectives of inventory management, elements of cost, the economic order quantity model, quantity discounts, and just-in-time. Let's now look at each of these in turn. The objectives of inventory management. Management implies guiding or controlling activities towards the achievement of predetermined goals or objectives. Accordingly, before we can consider how inventory will be managed, it is necessary to clearly identify what we are trying to achieve. The objectives of inventory management are twofold. 1, to avoid stockouts, and 2, to minimize the costs associated with the purchasing, ordering and holding of inventory. In order to achieve these aims, rather than thinking of inventory in total, as was the case in the working capital cycle presentation, we need to think about each individual item of inventory. Potentially, this will entail a tremendous amount of work, and in some cases the time and effort required to manage an item may not be justified given the relatively low value of the stock item itself. Consequently, many firms will adopt an ABC system, whereby high-value items are designated as Category A and will be subject to rigorous scrutiny. Conversely, low value, category C items have far fewer controls and may be available on free issue. Obviously, category B falls in between. Elements of cost. In simple terms, there are three categories of cost in relation to inventory. The buying or purchase cost, P, which refers to the cost of acquiring an item. In accordance with financial accounting standards, this will also include costs incurred in getting the item to its current location, for example, delivery costs. The total annual purchasing costs incurred will be P multiplied by D, where D is the annual demand. The cost of placing an order, CO, which includes all of the costs incurred in ordering inventory from a supplier. Though not exhaustive, these will include stationery, computer processing costs, postage costs, etc. The total annual ordering costs will be CO multiplied by the number of orders placed. The number of orders placed will be D divided by Q, where Q is the quantity ordered each time. Finally, the holding cost, CH, is the cost of holding one item for 1 year. This will include the costs associated with holding and moving an item around the facility, and or the opportunity cost of having money tied up in inventory, and therefore not available for other investment opportunities. The total annual holding cost will be CH multiplied by the average quantity held, i.e. Q divided by 2, where inventory is used at a constant rate. Similarly, the average quantity held will be Q divided by 2 plus B, where B is a buffer or minimum inventory level held. Economic order quantity. The economic order quantity, EOQ, is the quantity to order each time in order to minimize inventory costs, and is given by the following formula. The square root of 2 multiplied by the cost of placing an order, CO, multiplied by the annual demand, D, divided by the cost of holding one item for 1 year, CH. You may notice that the purchase cost P does not appear in this formula. This is because the EOQ model ignores the possibility that quantity discounts may be available. Accordingly, whether you order one batch of 1,000 or 1,000 batches of one, the total purchase cost will be exactly the same and as such does not affect the decision. Other assumptions of the EOQ model are: inventory is used at a steady rate throughout the year, and replenishment is instantaneous once the reorder point is reached. Or, perhaps more realistically, the lead time is consistent and can be predicted with accuracy. Quantity discounts. As discussed already, the EOQ model identifies the quantity to order in order to minimize inventory costs, i.e., the cost of ordering costs and holding costs combined. A business that is placing orders for any other quantity will incur a higher combined cost for CO and CH than is necessary. However, as also discussed, the model does not consider the potential existence of quantity discounts and will not consider this aspect where they do. Accordingly, where discounts are offered by suppliers, an amended approach is required. 1. Calculate the total inventory cost incurred, i.e. ordering, holding and purchase costs, if the economic order quantity is used. 2. Calculate the total inventory cost incurred as defined above at the minimum order quantity required to earn each level of discount. And 3. Choose the order quantity with the lowest total annual cost. For example, imagine a company has calculated the EOQ as being 50 units. The supplier is willing to offer a 1% discount if 75 units are ordered, 2% if 150 are ordered, and 5% if 250 are ordered. The company would calculate the total cost based on order quantities of 50, 75, 150 and 250 units, and then select the quantity with the lowest cost. Just in time. Just in time, or JIT, is a business philosophy built around excellent quality to provide the customer with what they want when they want it. This presentation is not going to discuss JIT in detail. However, central to a JIT approach is the principle of holding little or no inventory. This appears to be contrary to the EOQ model, as whilst holding costs will be very low, the company will need to place lots of orders for small quantities and will, as a consequence, incur high ordering costs. Supporters of JIT would refute this and would argue that the EOQ does not consider all of the costs associated with inventory. Specifically, they would suggest that companies hold inventory to cover up problems or weaknesses within the business. These problems will include unreliable suppliers, poor industrial relations, lack of or poor planning systems, poor quality work leading to rework or scrappage. All of these will make the coordination of material needs and supply extremely difficult, and indeed the holding of inventories allows these inefficiencies to exist and to continue. All of these issues will damage the organisation and accordingly will represent a cost to the business that should be considered. Thank you. Hello. In this presentation I'm going to look at the management of receivables and payables. In many ways receivables and payables are the same thing, the difference being determined by which side of the negotiating table you are sat at. As such, this presentation will focus primarily on receivables, however, will end by explaining how the issues discussed can equally be applied to payables. Specifically, this presentation will consider what are receivables, the credit control process, cost versus benefit, and payables. Let us now look at each of these in turn. What are receivables? Receivables, or debtors, are the amounts owed to a business by its customers in respect of sales made on credit. Offering credit is one way that a business can attempt to attract customers, and this is discussed in more detail in the Introduction to Working Capital presentation. It does, however, expose the company to additional administrative effort and the risk of payment default. Accordingly, it is important that 1. The company has appropriate processes and controls in place, and 2. Any benefits associated with offering credit in terms of additional sales volumes are weighed against the costs of managing the process and of tying up financial resources. These factors will be looked at in more detail below. The credit control process. When a cash sale takes place, for example, in many low-value retail transactions, the provision of goods or services and the resultant payment take place instantaneously, and no record keeping is required other than the recognition of the transaction for financial accounting purposes. Conversely, when a sale is on credit, the provision of goods and the payment are separated by a period of time, the credit period. Effectively, the supplier is trusting the customer to pay at a later date. Indeed, the term credit comes from the Latin word credo, meaning belief or trust. Under these circumstances, the supplier must protect themselves from the risk of non-payment, and therefore having proper controls and processes in place, including accurate record keeping, is extremely important. The process can be broken down into 3 broad categories. 1. Determining whether to offer credit and how much. 2. Deciding who to offer credit to. And 3. Debt collection. Whether or not to offer credit will, to some extent, be influenced by the market and customer expectations. However, the company will also need to consider what it can afford. This latter aspect is discussed in more detail in the working capital cycle presentation. In deciding who to offer credit to, the company will need to consider the credit worthiness of the customer. This can be assessed by reference to their accounts or by obtaining credit references from banks or other suppliers. Alternatively, they may use the services of credit rating agencies. Once the decision to offer credit has been taken, it is imperative that processes are in place to invoice accurately and promptly, issue any credit notes required swiftly, issue monthly statements, and trigger appropriate action where payment is not received in line with contracted terms. These actions may include phone calls, letters, visits, legal action, etc. Finally, the company should ensure that credit limits are reviewed based on trading history and that credit is withdrawn from non-payers. Cost versus benefit. As has already been discussed, companies will offer credit to attract customers. They must ensure, however, that the benefits in terms of additional profits outweigh the costs associated with the administrative effort and the money tied up in working capital, especially receivables. This cost-benefit analysis can also be applied to using debt factors, offering settlement discounts, or increasing the credit period offered. A debt factor will provide a range of services for a fee. These may include management of the credit control function, advancing monies invoiced, and, in the case of non-recourse debt factoring, protection from bad debts. The company will need to compare the factor's fee to the benefits derived. For example, reduced admin costs, reduced bad debts, and lower receivables. A company offering a discount for early settlement is effectively giving away part of its profit. It should only do so if this is outweighed by the savings associated with lower average receivable levels. Increasing the credit period will mean that more money is tied up in receivables and therefore increased financing costs, as discussed in the working capital cycle presentation. Accordingly, it can only be justified on financial terms if the profit on the additional sales are greater than the finance cost incurred. In practice, it will be extremely difficult to estimate the sales increase due to the extra credit. It should also be remembered that additional sales are likely to require additional inventory, further increasing the need for investment in working capital. Payables. As alluded to above, payables and receivables face the same issues, albeit from opposite perspectives. Accordingly, many of the issues discussed above can also be assessed using a cost-benefit approach. For example, if a company is offered a settlement discount, the reduction in the purchase cost should be compared to the additional finance cost associated with paying out money more quickly. More generally, companies should aim to take advantage of as much credit as possible, it is effectively free finance, without jeopardizing the relationship with their suppliers. Thank you.
In this section, I will go over determining working capital needs and funding strategies. You should already be familiar with working capital before starting this video. Please take the time to look over working capital in introduction and the working capital cycle. In this video, we are going to look at calculating the working capital investment needed. We're also going to look at the key factors when determining working capital funding strategies. So let's begin. Calculating the working capital investment needed in an organization. You already know that working capital is the lifeblood of an organization. But how do you know what level of investment is needed? The level of working capital depends on the following: the length of the working capital cycle, the organization's terms of trade, the organization's policy on the level of investment in current assets, such as inventory, and finally, the industry the company is in. The length of the working capital cycle. This is the time period between the organization paying for its costs and receiving cash from its customers. These depend on the organization's industry. The working capital cycle is explored in earlier videos. The longer this time period is, the higher the organization's working capital investment will be. Organizations that have a long working capital cycle would be accountancy firms or construction companies. These organizations will have higher levels of current assets, such as cash, to enable them to keep up their daily operations. For example, it may take a construction firm a few years to get paid for a real estate development, but they will need to fund their staff salaries and the construction of the project in the meantime. So they will have to have high levels of cash to fund this. The organization's terms of trade. What does this mean? These are the terms the company offers to its customers. The length of credit terms will determine the length of the cash flow cycle. To reduce them, companies can offer discounts for early payment. Although companies can decide on their terms of business, often they must follow what their competitors are doing. For example, if an organization's competitors are offering 30 days credit, they will need to offer similar terms so as not to lose out on business. When deciding on their terms of business, organizations should calculate how much the proposed terms of business will cost them. For example, if the weighted average cost of capital of an organization is 5% per annum, and the average credit sale is $5,000, they offer their customers 60 days credit. The cost of this is $5,000 at 5% and then 60 over 365 days. This is $41.10. So the cost of financing these credit terms will be $41.10 for the average customer. Now companies could look at how much it would cost them for, say, 30 days or 40 days and compare. Armed with this information, the organisation can evaluate different terms of trade and their cost benefit, i.e. the cost of financing them versus the potential sales lost by changing these terms. The more generous the terms of trade are, the higher the investment in working capital will be. This will be a trade-off for the organisation, as the more generous the terms of trade, the more attractive they are to customers, resulting in more sales. But they will have to fund these sales. The organisation's policy on the level of investment in current assets. This comes down to the organisation's attitude to risk. A company with a conservative attitude to risk will invest in current assets such as inventories and cash. This means that they can offer generous terms of business, as they can keep their daily operations going while awaiting for customer payment. Some people think that investing in current assets in working capital is a waste, as the excess could be invested to develop and grow the business. A more aggressive organisation will not invest as much in current assets and will be more profitable as a result. This is riskier, as they can run out of inventory and lose customers, or worse, run out of cash and get into a position of overtrading. The industry the company is in. I've already touched upon this, but the level of working capital investment that is needed does depend on the industry the organisation is in. Going back to our construction company example, they may take years to get the sales from their customers. Compare this to a coffee shop. They are paid immediately by their customers, and they can reduce their inventory investment by careful management. What are the key factors when determining working capital funding strategies? Here, you will look at permanent and fluctuating current assets, short and long-term finance, the matching principle, the costs and benefits of different funding policies, management's attitude to risk, previous funding decisions, and organisation size. Permanent and fluctuating current assets. So what are these when they're at home? The normal level of investment needed to support a normal level of sales. If the company decides to expand and increase its sales, this core level goes up. So if we take an example of a toy shop, the management should know month on month how much inventory, cash and other current assets they need to keep operations running smoothly. This is the permanent working capital investment needed. If the shop decides to expand and, say, open another shop or perhaps sell online, this increases the permanent current asset investment. The organisation will always need to have this amount invested. If not, they will negatively impact on their operations. Now, the same toy shop will have to increase its inventory levels at peak periods such as Christmas. This increased investment in working capital is a normal part of business, and because this is not permanent, like the toy shop expects to have the inventory levels back to normal after the busy period, so say in January. The difference between a permanent and fluctuating investment is the time the investment is needed. The permanent current asset is in its name. It is permanent. Sometimes this can increase or decrease during the course of business, as you see with the toy shop. So when determining the level of working capital investment, the organisation must remember to take the fluctuating current assets into account. The cost and risk of short and long-term finance. You should already be familiar with the concept of long and short-term financing. In the context of working capital, sources of short-term finance include trade creditors. When organisations buy from suppliers, usually they will not pay up front. Instead, they will receive the goods on credit and get paid after 30 days, or whatever their supplier's terms of trade are. This is a free source of short-term finance. Sometimes organisations will offer discounts for early payment. For very big creditors, the organisations should measure these discounts against the cost of financing the working capital. Although this is a free source of finance, organisations should not abuse it, as it will result in poor supplier relations and the reduction on credit terms. Bank overdrafts and short-term loans, which you should already be familiar with. Invoice discounting or invoice factoring, where an organisation can sell its accounts receivable to an invoice financing company for cash. They sell the invoices for less than the value, and the difference is the financing company's fee. This is a good source of short-term finance as it doesn't affect the company's gearing levels. Customers are also unaware that their bill has been factored. The organisation can also reduce their risk of bad debt, depending on the agreement with the factoring company. However, if the organisation has tight profit margins, the factoring cost may be too high. Long-term finance sources would be, say, loans, long-term loans of, say, over 20 years, mortgages, investors' funds, and retained earnings. Short-term financing typically tends to be more expensive on an annual basis than long-term debt. However, this is because long-term finance is given by the investor or the lender on the basis of it being a long-term investment, and they will receive a higher return over the long term. The asset being financed should be matched with a finance source. So long-term investments like a factory building should be matched with a long-term finance such as a 40-year mortgage. The benefits of this asset will occur over a long period of time, and the finance source should match this. This is the matching principle. For example, the toy shop from earlier shouldn't use a 40-year long-term loan to fund its temporary increased inventory at Christmas time. This is a current asset that fluctuates, so a short-term investment and the funds from it will be released in 30 to 90 days, so it should be funded with short-term finance, for example with trade credit, a bank overdraft, company credit card, etc. Also, a mixture of short-term financing could be used. Example, Toys Inc. buys $100,000 of Christmas stock, which is delivered on the 1st of October. They are given 30 days trade credit. After 30 days, the 30th of October, they pay the supplier partially by credit card up to its $50,000 limit and partially by bank overdraft. Toys Inc. has sold enough stock by mid-November to pay off half the debt. They pay their bank draft first, as interest is charged per day of overdraft, whereas their credit card offers 60 days credit. By December, the organisation can pay off its credit card, but they don't. Instead, they use the available cash to generate more revenue or to pay their suppliers who offer high discounts for early payment. This is because they are maximising the 60 days free credit their credit card offers. At the end of 60 days, the end of December, Toys pays its credit card bill, avoiding the high interest charged by the credit card company. As you can see in this example, Toys Inc. has maximised its sources of short-term finance, and the extra cash they received from selling their inventory and not having to pay their credit card immediately means that they used the cash to get discounts and take advantage of business opportunities. If Toys Incorporated had not matched their short-term inventory fluctuation, they would have been left paying loan repayments long after the need of the capital had passed. Often hefty penalties have to be paid if you want to exit long-term financial lending arrangements. This is to compensate the lender, who is losing out on the returns over a long period of time. The permanent investment needed in working capital under the matching principle is matched by a long-term source of finance. This can be a little confusing, as inventory, etc. are short-term or current assets. However, this consistent investment is long-term. Although the inventory might change and the assets themselves may change, it is a long-term investment. Management's attitudes to risk. We've discussed various funding policies and each of their pros and cons. What an organisation selects depends on their attitude towards risk. An aggressive working capital policy is where the owners and management acting on their behalf will want high profits and growth, and will manage their working capital in this way to maximise the capital so it can be invested into the business development and growth. A matching working capital policy matches the cash flows of the organisation, resulting in a less risky position and it being less likely to run out of cash. This policy is the medium between an aggressive and conservative funding policy. However, in practice, it is not as easy to apply, as some organisations may not have access to enough long or short-term finance, so they cannot match their assets with their funding. A conservative policy would be adopted by risk-adverse management. Shareholders who are risk-adverse and want a steady, consistent dividend. So aggressive working capital policies that risk the organisation running out of cash and being unable to pay a dividend are not what they want. They will invest in working capital to ensure that this doesn't happen. Previous funding decisions. Have you ever heard of the phrase, once bitten, twice shy? This is where your past experience is affecting your current decisions. This is relevant in business and in life. Management's experience and history with funding will determine the current organisation's policy, whether it is an aggressive one or a conservative one. For example, if they ran into cash flow problems in the past, it is likely they will take active steps to ensure they have enough cash in the business. The size of the organisation will also factor into what funding policy an organisation selects. A smaller company will not have access to the same resources that a large multinational has. For example, they may not be able to get as much long-term finance from a bank or from their investors to fund their long-term capital need. This may force them to adopt aggressive working capital tactics and reducing investment in inventory and relying on trade credit. Try and apply what you have learnt to practice. What is the working capital policy in the organisation that you work in? What is your assumptions based on? Or what indicators of it do you see? The Baumol cash management model. This model treats cash like inventory and finds what the company's optimal cash amount that should be invested or transferred at any one time. This is similar to the economic order quantity used for inventory management. It is calculated as follows. Optimal cash equals the square root and 2 multiplied by CO multiplied by D divided by CH. CO equals transaction costs. D is demand for cash over the period. CH, cost of holding cash. So let's apply it. Fashion Incorporated has a $5,000 excess cash balance per month. The interest rate on deposits is 2.5%. The transaction cost per transaction is $50. What is the optimal transfer amount? So the CO equals 50, D equals 5,000, and CH equals 2.5%. The square root of 2 multiplied by 50 multiplied by 5,000 divided by 2.5% equals $4,472. Every time a transfer is made to the investment fund, it should be $4,472. Now, this model, like the economic order quantity, relies on a number of assumptions. Cash is used in a steady and predictable manner. A quick note on this. Businesses are rarely steady and predictable. And this makes the result of the Baumol model unreliable in less than certain circumstances. Cash inflows are known and regular. A company can know what money is owed to it. It doesn't necessarily mean that they will receive payment when expected. This assumption reduces the reliability of the model for many businesses. 3. Daily cash needs are funded via a current account and buffer cash held in short-term investments. These assumptions are more likely to occur and something that most businesses would strive to achieve. However, anyone who works in business will know that this is often not the reality, and day-to-day expenditure could be funded by short-term loans, etc. So, as you can see, in reality, this model is not suitable where there is uncertainty over cash flows. That said, it is a useful calculation to do as it draws awareness to transaction cost and the opportunity cost of cash stored in the business rather than investing it. Thank you. Miller-Orr model. This is one model that can be used to manage cash. It is used to set a target cash balance for the company. The model sets a high and a low point of cash for the company to hold. The model also sets an ideal cash level called the return point. See the diagram. Line H is the maximum cash the company will hold, and line L the least. And Z, you may have guessed that this is the target cash balance or return point Z. And now you see a yellow wavy line on the diagram. This is the actual cash balance in the company. And as you can see, over time it is high and it is low. This model identifies the highest and lowest level of cash the company should hold and the ideal balance it is striving to reach and maintain. Once these high-low limits are hit, action is taken. You'll see at point X that the cash level is well above that of the target. This cash should be put into market securities and not just left in cash. Ideally, these securities will give a good return and the company will grow. How much should be put into the security? The amount from point X to bring the balance right down to line Z. So let's say point X equals $150, H $110, and Z $50. The amount transferred into non-cash securities is as follows. 150 minus 50 equals $100. By transferring this, the cash balance is brought back to the ideal Z. You could say the company is a bit sloppy at applying this model, having let the balance go to $150 when it should not go past $110. Now, having a cash balance that is too low presents a whole other set of difficulties. I'm sure that you would agree. Here, let's say the minimum level is $25 and we see that point Y is below that. What do we do if the cash balance hits its lowest threshold, or even lower than that, to point Y, which is $5 in this example? You should know by now that the company wants to maintain its cash levels at the return point. So in this example, it is $50. So the company would convert its non-cash securities into liquid cash to restore the cash balance to Z. How much does the company need when it is at point Y? To restore the cash balance to the ideal, it is $50 less point Y of $5. So it needs $45. Okay, so you now know how the model works. How do you set up this model? Firstly, you need to set up the maximum and minimum points. The minimum point is set based on management culture and experience. It is guided by how much cash shortfall the company is willing to accept, and the market circumstances, meaning how easily cash securities can be converted and borrowings can be assessed. So, for example, in a market where cash is hard to come by and borrowing costs are high, the minimum cash level will be much higher than in a market where interest rates are low and borrowing is cheap, and the non-cash marketable securities are easily converted into cash. So, as you can see, there's no exact science in setting this level. It involves management's attitude to risk, the ease of converting marketable securities, and the ease of borrowing. The maximum cash balance can be calculated once the minimum has been set. This is calculated using the spread calculation. This formula gives the difference between the max and minimum points, i.e. the spread. The formula is spread equals 3, open parentheses, and then 3/4 multiplied by transaction costs multiplied by variance of cash flows. Then this calculation is divided by the interest rate to the power of 1/3. This formula requires variance of cash flows. These should be in daily terms. What is variance? It is the standard deviation squared. Once you know the spread, the maximum point is found by adding the spread to the minimum point. What about the ideal cash balance, or the return point? The return point equals the lower limit, and then add that to 1/3 multiplied by the spread. You can see that each point feeds into the next. Okay, now let's tackle an example. I want you to attempt the example that will come up on screen. Pause the video and apply the theory we just did, and then I will review it with you. So pause the video now. Fashion Incorporated is a successful retailer, and the directors have decided the lowest the cash balance can go is $10,000. Transferring money to or from the bank costs $25 per transaction. The standard deviation is $1,500 per day. The interest rate is 0.03% per day. The directors need to know what is 1. The spread between the maximum and minimum amount of cash the company should hold. 2. The maximum balance of cash the company can hold. And 3. The return point. Did you attempt the question? It's your last chance to pause the video. Remember, we learn by doing. Okay, so we need the spread, the maximum and minimum cash the company can hold. Let's work through them as we see them. The spread equals, and then we've got the formula. So the transaction cost is $25. Variance is the standard deviation squared. The standard deviation is $1,500. It is squared, and that's $2.25 million. The interest rate is 0.03%. So let's apply the formula. So we've got 3, and then inside the brackets we have 3/4 multiplied by 25 multiplied by 2.25 million. That's divided by the 0.03%. And then that's all to the power of 1/3. And you get $15,600. That is the spread. That's the first part of the question answered. Part 2, the maximum balance of cash the company can hold. We now know the spread is $15,600. Add that to the minimum balance is $10,000. So the maximum balance is $25,600. Now let's calculate the return point. The return point equals lower limit plus 1/3 multiplied by the spread. The lower limit is $10,000. The spread is $15,600. 10,000 plus, and inside brackets, 1/3 multiplied by 15,600, which is $15,200. Now you know the ideal point is 15,200. This is the cash balance Fashion Incorporated should have. The maximum point is 25,600 and the minimum 10,000. The benefits of the Miller-Orr model is that it gives clear cash balance parameters of how much cash is ideal, too little or too much. It also gives actions of what to do when cash is too low or high. The activity of implementing the model is great for an organisation as they must analyse and dissect the company's cash needs. The main disadvantage is that there is no objective guide in determining the minimum cash limit, cash balance.